Hey everybody, this is Paul doing a dividend video. The date is currently August 15th. It is 2:56. The market is about to close. So as you can see, market's down. So, you know, I like to be fully transparent. Not every day is a winner, right? So, I guess let's go over August. Um, what we got going on. Just the different kind of things, portfolio moves, that kind of stuff. Since the last time I did a video. So one thing that I did do since my last video, for sure, is this one thing I mentioned that I might do is I was very close to hitting this target right here on BST, so I decided to sell, I think SPHD or maybe AFB, one of these, probably AFB, and buy the shares that I needed to hit this target right here. So if I go back to this screenshot, you can see exactly what I did here. So at this point I hadn't hit it. I was maybe about 100 or so shares off from it, so you can kind of see what I did. So I pulled out of AFB, about 5,000 out of AFB, dropped it into there. Boom, there you go. So I hit that target, so that means dividend reinvesting is turned off on, what, $228 worth of stuff right now. All of that, it's piled into there, except for today. Today was actually kind of kind of different. Um, oh, uh, went down into a range that's just a straight up buy. Anything below, I mean, obviously, anything below 60 is a buy, but anything below 57 or 58 is definitely a buy. Sets off all kind of like little buy things. Just different people I follow on Twitter were posting charts saying that it is definitely oversold. Um, so, I guess this video, since my account is mostly just basically buying SPHD and AFB now until I hit $90,000 more in money spent. Um, I guess I just want to kind of go over stats, different stuff, different risks that could be going on as everybody prices out a recession, but they have to price in higher for longer. And what does that actually mean? So higher for longer is this is a bond market that looks very much like this because a lot of the bond market right now currently thinks that the Federal Reserve is going to pause at the September meeting. And if inflation data keeps going the way it is, we could see a three handle on the inflation number. Even with gas where it is, we could see a three number, which is very weird to think about because the Atlanta Fed keeps having GDP for for the third quarter here now above 5 as retail spending is up. So you have a lot of very weird indicators and things going on here. So the Fed excludes oil for a good reason from their decisions, or they're supposed to, or else the Federal Reserve would have to adjust interest rate policy every time that OPEC meets. If OPEC cuts, then the Fed would have to raise rates. If OPEC decides that they want to do more output, then the Fed would have to ease rates. It would be ridiculous. It would not be an independent Fed, that's for sure. So the market is currently reacting to this right here, the 10-year. That is what the market cares about. And the reason why the market cares about that is that's because that's where long-term financing of corporate debt and deals come from. So, and then also what's going on is this rate is right at the exact same level, right around the exact same level as when we hit that big time 35, 55 level on the SPY. Like the market was much astronomically lower, 1,000 points lower than where it is now when the 10-year was at this level. So bears are holding on to this, thinking to themselves, well, we're at this level again. We should go, you know, astronomically lower. But earnings support kind of these levels in some stocks that they do. Home Depot came out today and it shows that housing's slowing everything down, but they're still reporting, they're still hitting their targets. So, that's one big risk in the market right now. That's actually the biggest thing driving this market for pretty much since the last time I made a video. Is you can see that the 10-year is just going up very quickly in August, and that is just 100% related to just pricing in higher for longer. That we're going to be at these rates for much longer. If you look at where it was on, say, the 31st, it was there, and now it's here. And that might seem like a very small move, but that's enough to move this market by quite a bit. So until we start getting long-term, the 10-year to come down back around like say 3.5 or whatever, like in this little area here, if you notice, we rallied the entire time and we dropped whenever the 10-year went above 4. So whenever the 10-year goes above 4, the market starts to drop. When the 10-year goes above 4.2, the market really starts to drop. If it goes up even more from here, we're going to run into more problems. And the reason why people think it might go up more from here is because China has to sell U.S. bonds or whatever left they have owned to support their currency, which is currently devaluing at a pretty remarkable pace. Japan's also having a very big problem right now too. If you look here, so we got a lot of stuff going on. There's a lot of currency-related issues. There's a lot of bond-related issues. And pretty much all these people that jump on here, any of these networks are probably going to mention this also, is that the bond market is driving the stock market right now. As long as the 10 years above 4%, the bond market is going to drive the stock market. So we currently have a trading range or a trading area above 4,400, probably 4,350 to be honest with you. 4,350 to 4,450 or 4,500 seems to be kind of the area we're in right now, which I'm perfectly fine with. We did something similar. If you notice right here, we sat in this range, this range right here, this 4,000 area to 4185 area from what right here from April till June and didn't move. If this market moves sideways, I'm perfectly happy. I'm 100% perfectly happy because it gives me a chance to add whatever I want to add. Especially since I'm buying passive ETFs. It doesn't really matter what you buy right now. It's like, in a few years, it's probably going to be worth more. At least I would hope it would be worth more. So higher for longer, what does that mean? That means the assets on bank balance sheets become more liability. So you're going to start seeing more different things from the ratings agencies. So different things like that happened today, which is right here, may be forced to downgrade dozens of banks. That's what higher for longer stands for. The longer that rates stay this high, the more that things sitting on people's balance sheets become worthless. Because they can't get rid of it unless they can get rid of it for pennies on a dollar. So what I would suggest is to follow Andy Constant. He's putting out incredibly quality content for free. He was like a hedge fund guy for 25, 30 years. So I strongly suggest you follow him. Ignore him whenever he makes a call on like green or red day. It's definitely a coin flip there, but whenever he posts different charts like this, he's pretty much nailed every single sell-off. And it's purely just going by what the bonds are doing. Tons of debt coming on. Somebody has to absorb it. Money comes out of the market, and this is what you get. He's pretty much nailed a lot of these whenever they have to refill the treasury account and all that. He's pretty much nailed every single one of these drops, and you can tell. So that's definitely who I would say follow. Jason Furman puts out some good stuff too. So this is the Atlanta Fed chart. So right now, as the plan stands, this is the plan. Right now, just keep piling money in. Into these two ETFs. There's going to be a very large amount of money piled in there. And then as you can see, now that, my kids are back in school and stuff like that, I've obviously gone hard to the paint, as they say. Just, pouring money in. As it stands, the consumer in South Louisiana, at least, when the temperature outside is 115 degrees, is very strong. And the demand for delivery services is very high. And consumers are willing to pay up to have you deliver their stuff in 115 degree heat, which I appreciate. Because it is very hot out there. You will literally burn your arm sitting there with it in the window. So the consumer is still remarkably strong. Even though the manufacturer numbers are still coming in very weak. Even though the Chinese numbers are coming in just horrible. So there's very little global support for markets at the moment. Europe's kind of weak, but they're still avoiding recession. China's basically in a recession. They're not even publishing their youth stats anymore, or their youth unemployment stats anymore. It's another one that they're not going to publish. So, and then inflation's coming down at the same time. So we kind of have like a, it's hilarious. We have kind of have like a Goldilocks thing going on where somehow rates are this high, you know, every indicator is literally telling you that you should be, you know, we should be kind of starting to have a slowdown going into a recession, but we're not. So we definitely have to watch it. So the biggest thing that you need to watch right now if you're going to trade this market is you just basically watch bonds. If the 10 years above 4%, that means stocks are going to go down because corporations like to issue debt on the long end. And, governments like to issue debt on the long end too. The further out they can push the debt, well, that's going to push up the rates. So more money coming out of the market. And there's definitely been some issues with debt. So this is where we're at right now. So as you can see, but right now, every little dip I keep buying. So you just have to decide what your own personal trading strategy is going to be. And then once the Fed, so the next big date is obviously going to be right around here for the September, for the August CPI, which I have imagined is going to come in very oddly enough to say it's going to come in weak. There's just old rent data that's coming through, and the car prices are coming down dramatically because the rates are just killing them. So the August data, even though the consumer is incredibly strong, the other data is just going to come in incredibly weak, which is very weird to say. So watch that CPI data. I think if it prints in the 3 area, the Fed is probably going to come in and say pause. Maybe. If they don't pause, you're going to see chaos in the bond market, probably. If they don't pause, I imagine the market is very much going to react to that. This is going to go above 5 for sure. This is definitely going to go above 5. I don't know what this would do right here. I don't know what the 10-year would do. The 10-year would probably go higher because people would demand a higher premium. So I imagine 4.4% is out of the question if they don't pause. And then, the stock market would certainly respond to that, and they would push this into the 4,300 range. So that is definitely currently where we're at. Like I said, just going to keep contributing, adding more. So even though I got losses for the month because of the market going down, the video is only going to show a minor difference, I believe. Yeah, it's going to show a difference from my last one, but majority of that is just me adding money, my own money, since the last time I did a video. So, just take that for what it's worth. There you go. So $1,100. But, like I said, very long-term focused here. And then when the market decides it wants to rally back, these would be the ones that rally back. So that's currently where we're at. Just leave any questions, of course. I'll answer whatever you got. So thank you so much for listening. Have a nice day.